Hey guys, Ron Rohde here again with you today. We're really excited to create a Waterfall template partnership agreement. Now, this is something that a lot of the viewers have asked me for. They have a model, they have a partnership between two parties, usually a general partner and a limited partner. How do these two people come to agreement on the terms of their investment? Well, this is the document that you need to outline the rights and responsibilities of both parties, as well as outlining the return of capital when certain thresholds are met. There's a wide range of legal options as well as modeling options that you can put into a sophisticated project. Correspondingly, you should understand how the legal document works. So today I have with me Matthew Green, who is a seasoned real estate analyst and acquisitions expert. He's been buying multifamily for over 8 years, and we're just really happy to have him today. So Matt.
Happy to be here. Good afternoon, Ron, and good afternoon to the Adventures in Commercial Real Estate community. Very excited to discuss this afternoon. At the end of the day, you can have the best potential acquisition on deck. You can model it to the best of anyone's ability and have a great deal in front of you. But if you don't have the correct, legal nuts and bolts in place, you could really be placing yourself at risk, or a slight deadline or anything in breach of the contract can really put the deal off to the wayside, unfortunately. And so that's what we're here to discuss today.
Absolutely, absolutely. Legal, it's an important component. It's not the end-all be-all, but it is important, and you should allocate a fair amount of time to understanding what your options are within the legal document, as well as incorporating terms in the model. We have a lot of assumptions on here, but for the most part, tell us about a typical structure, Matt. The general partner, how much authority and leeway do they have when they're negotiating with a limited partner?
Well, the first rule of putting these together is always remember, never ever forget that anything is negotiable. The first rule of negotiation is always ask. So if it's a deal, someone who you've done business with before, kind of have an idea of what works for both of you. But oftentimes when two capital partners, a capital partner is coming together with general partner for the first time, often it can be very interesting when you're negotiating your first partnership agreement. It's definitely worth it, to see kind of where the other party lies and then eventually come to an agreement. And these, it's not uncommon for it to take weeks and weeks to get this hammered down. It might seem like any and all scenarios are laid out, but this is why the law is always an evolving subject, because unprecedented things happen, whether it's in the economy or with the physical aspects of an asset, force majeure and things like that. It's always evolving. The nature of these partnership agreements, it will never cover the full scope of what could happen. But first and foremost, you're looking to protect yourself and your interests while also aligning the interests at the end of the day with your partners, because this is why you're doing business together, because you're both in it for the same economic ends.
Absolutely. So that is a lot of great legal insight. Sounds like you've looked at a lot of these contracts before.
Oh man. Well, first of all, not so much at the analyst level, but when you start getting up to the associate level, you're more, making deals happen rather than doing a lot of the analysis. You're checking a lot of things, and that's when I really got the bulk of my experience.
We'll jump right in. The first assumptions that we make, there are a lot of terms that are thrown around, like general partner. And general partner, manager, sponsor, I don't think that they're all interchangeable, but it all depends on consistency in terms of how you refer to it in the agreement. For the purposes of this video and truly, most of my articles, not the legal documents, but the articles, we use those pretty interchangeably. You have a sponsor, you have a developer, you have a general partner, somebody who is responsible for the day-to-day decisions, organizing the property, the financing, the debt, the project plan, the business plan, calculating the model, the returns, and it will correspond. Matt refers to a capital partner. That can be your limited partner. Essentially, that's somebody who is going to contribute money and have a passive role. And that role is just passive, defined as less than active. So I'm not going to dig into that too much, but just so you guys have a general idea, for people coming up with this, or if your documents use different terms, it doesn't necessarily mean that you're referring to a different situation. You just may use different definitions. Just wanted to clear that up. Let's go right into it. One of the things that I want to talk about is, Matt, how have you guys defined IRR? It's something that is like a can of worms, and legally I've dealt with it a lot. How have you guys dealt with the different ways to define an internal rate of return?
IRR is not always used. It is one of several metrics that you can use to form the basis of economic distributions from the cash flows that come out of a real estate deal or any other deal for that matter. The basic thing to remember, so it's either cash on cash or IRR. 95+% of the time that is what it's going to be. Sometimes they might do like some other metrics like an overall return or an equity multiple, but really, I mean, all of those tie together in the end. Into IRR, if you've taken some basic finance classes, you may know about the present value of money. You take your overall economic contribution is, so that includes everything that the partnership puts toward equity, toward the purchase price, and on top of that, any CapEx, so capital expenditures like renovations or any maintenance upfront or deferred maintenance that you're doing as part of the overall economic plan for the project. So that is considered your upfront investment. And then let's say hypothetically, it's on maybe a 5-year timeline. So, year one, you have the purchase price, and then you have additional CapEx you have in. So that is your initial big investment. Middle 3 years, you will have cash flow for each of those years. And then say we have a sale in year 5, you'll have the cash flow. And then on top of that, any economic capital gains you have from the gain in price property. And
the exit, from an exit.
Correct.
Or refinancing maybe.
Yeah. And so you take that and divide it by the number of time periods, and then factor in, of course, the time value of money. And then that is how you get your internal rate of return.
The IRR, we can incorporate the legal definition of IRR to reference Microsoft Excel and specifically how they calculate it, whether it's on a 360 period or 365, however you want to be precise in defining your model, the legal documents should take that into account. I think this is an important point of definitions of IRR. It's not enough to use a generic definition if it changes the cash distributions in your model, relying on another form of calculating the economic return like Matt just so eloquently described. You need to make sure your legal documents match that. Otherwise, an angry investor can recalculate using what they interpret as their definition and come up with a different number against the sponsor. So,
as simple as that may seem, this happens all the time. I cannot put that out there enough. You absolutely need to agree on the definition, because I hear about it all the time. Especially
and the more precise, the more ambiguities that you can eliminate, that is what's going to eliminate this stressful back and forth time. Tell us about the institutional contribution. What does the procedure look like when you guys have a LP, quote, subscribe? What happens if they sign the agreement and they don't wire the full amount of their funds? What would you guys do in a situation like that? Legal document can have a couple different options. You can sue the investor to make them pony up, which you kind of smile, but it's like some people do. To say, you promised me $100 million. You're saying you only want to do 50. It's really up right now because of my other commitments, and I can't get enough money, and I'm going to lose $10 million I put down as earnest money because I can't close. I'm going to sue you to put in the rest of the 50 because you signed and agreed to commit 100. And an investor subscribes, they agree to commit, they sign the agreement. What happens if they don't put all their money in? Situation or outcome that the GP wants, they should be sure to change their partnership agreements that reflects it, because
you want to have as many protections for yourself as possible. And obviously your LP is going to want as many protections for themselves as possible as well. I mean, at the end of the day, the essence of a partnership agreement is to make sure that the parties are held accountable to their commitments and that incentives are aligned.
And I would also say there's a third people should know what they're going into. Even if I agree to give the general partner a lot of discretion, I need to know where that line is. And I need to know how money is going to be returned. I even need an agreement. I'll just give you a check and be like, please give me my money back. So let's keep going. For the legal documents, I think it's important to understand, I will look at what type of project. So if the project is identified, Matt, tell us about a new construction, the phases of a new construction development, and how does that affect it versus, say, buying a core stable property?
Sure. So it really depends on the timeline of the investors, because for construction, I mean, you can have, oftentimes it depending on the size of the development firm. Sometimes the partners of the development firm will be able to put up the money and then be able to on that basis be able to get a construction loan and take it all the way through. But often, yes, you are going to need outside investors, to invest, get the construction
loan. So you
loan.
mean take down? They could the sponsor or the GP could take down the land first, for example, right. Pay for all the architect fees, pay for entitlement, pay for zoning.
Yes.
They are sinking a lot of money of their own money first prior to any transfer from an investor.
Yeah, and the LPs really don't get involved until it's time to get a big construction loan and really get capital.
Go vertical.
Intensive on it, yes. Or like literally until you get right before you get the construction permits, because and that's a fairly short time horizon, because maybe you have a 2-year construction period and then maybe a 12 to 18 month lease up period, and once you get it stabilized, that's when they look to exit.
Right. As I say, those phases are really important, because one of the decisions that I hear a lot is, what are the rules on distributions? Because during a lease-up period, you just gave a nice window, 12 to 18 months. What happens if the lease-up takes a little bit longer than that? Do they distribute the cash? What are the GP's options that you've seen? Let's say that if lease-up takes longer than expected, what options do you see for the GP?
Well, this is no different than your typical waterfall model. If you have a core property or a value add property, basically an existing asset rather than a development, I mean, you just have these hurdles. And then, certain financial hurdles will not be able to be met if you're not leasing up at the pace that you pro forma. And this is why, remember, in terms of the risk spectrum, the highest risk and highest return is in development. And really it's in the case of multifamily, the crucial, those 12 to 18 months are absolutely crucial, because every month that you're not getting to your pro forma, those are more units which are going to be finished, but they're not filled economically, with paying tenants. And so that, the difference between an 18-month lease up and it taking 24 months, it's only 6 months, but I mean, that can materially reduce the returns. And if you are a GP, that could seriously limit your ability to break into the promote.
Wow. So break into the promote, because the preferred is still carrying if they're not meeting even the preferred, for example, for distributions. And then that just puts them behind the 8 ball when they do lease up, that
Correct.
Sort of thing. Right.
Correct.
Right. Gotcha. So again, very critical to understand what your timing is going to be, because it costs a ton of money to service the debt, to service your LP, that sort of thing. So another big area, I get a lot of focus on this from my clients, both on the GP side as well as the LP vetting a contract, is fees. Matt, tell us a laundry list of the fees that the GP is allowed to charge, and who are they paying for these?
Again, always try. First rule of negotiation: ask, see what they can do. This is real estate. Fees are everywhere, especially in a low return environment, high price, low return environment like today. GPs are going to make their money somehow, because, they obviously, that they have to, well, people are working remotely these days, but in normal times, they'll have to pay for office space, they'll have to pay for their staff, and to run their business and so on and so forth. It's very common these days to see many fees in areas that we used to not see them. But that said, though, seasoned investors will push back. As a GP, you should expect it.
So tell me a list. Can you just, acquisition
Sure.
fees,
Yeah, absolutely.
permitting, reimbursement fees? What kind of fees are we talking?
Yeah, so in general, again, you can attach a fee to anything, but the most common one is acquisition fee. It's usually 1% or so of the purchase price. That is more or less the standard. Again, it is negotiable. And another one, of course, is the disposition fee.
Yep.
As well. You can also have an asset management fee, and this is one which it can mean basically just we want an extra fee per year, so we're just going to call it an asset management fee.
So some people don't charge. Do some GPs not charge an asset management fee?
Most don't, but
most don't. Okay.
In the recent market, especially in the apartment acquisition space of existing assets, a lot of these syndicators who are working more with mom and pop investors and not with sophisticated investors, I see these offering memorandums and I say, what is this asset management fee? And it's just an extra 25 or 50 basis points for them.
And you say it's not justified, or I'm hearing that it's not justified because with one property under the belt, they've got a single debt source, they've got a handful of LPs. There's really not much asset management to be done. They've got one property manager, they've got one software system that handles everything for them. So what? That's if it's a complicated cap stack, it might justify with government credits, low income, and tax credits and different government issues. That I could maybe see justifying more of a asset management.
Yeah, and let me quickly just point out that I am not referring to a property management fee because, if you're working with a vertically integrated sponsor who also has a management division, they essentially are paying themselves to manage the property. They're not making much on that, but it essentially should be viewed as more or less a zero profit area of the country or of the company. So like most of those sponsors those are not the ones who are going to be charging an asset management fee. That does not mean a management fee. That's totally different.
Yeah, and also to clarify too, when you talk about acquisition fee, this is in addition to commissions and closing costs. It's another layer on top of already high commissions to brokers, to your lawyers. You might have a debt origination fee. I mean, you might have points for your loan. So the acquisition is purely on top.
Another very common one too is your due diligence fee.
And that can vary a lot. I've seen it where it's a reimbursement of actuals, an estimated reimbursement, or just a flat fee, and they don't tell you how much they've spent because there are a lot of chase costs for travel and salary analysts and time. Those are real, but people pick and say, well, we have an acquisition, we have a due diligence fee of $200,000. Like, well, it's just 200. We spent way over 200, chasing down the last 6 properties, and that's the reality, right? They do have to spend time looking at non-viable candidates, and that costs money. How many do they look at? How much do they spend on each property? Well, they got to make it up on the deals they do close, but you have no idea as an investor how to vet that, or you could, how do you push back? So
exactly. Yeah. I mean, the best real estate businesses, at least in the acquisition side, are the ones that have a cost structure that's well below what they're taking in acquisition fees. But, especially when people are getting started out, are getting their businesses off the ground. And, you don't know when the next acquisition fee is going to come because you may have not really gotten off the ground yet. Yeah, it can be tough. It can be really tough. And of course, you don't have the track record. So, you're really having to deal with the fact that you really don't have as much leverage in your terms.
Absolutely. And I think you hit on that earlier, but everything is negotiable, but it comes down to who has the leverage in the situation. If you're the GP with a stellar track record and you've done a couple projects and you're doing another one that's right in your wheelhouse, you're probably going to be able to dictate terms if they're within market and you don't have to negotiate much. If you're a newer developer and you need this capital, you're going to probably concede and you're not going to have leverage with the capital providers. So it's all an incredibly soft skill. You know, it's like a political question. It has nothing to do with what the model says and what the return is and the risk adjusted return should be for this property. It's just a negotiation that, again, can make or break your investment if you don't pay attention to it and just let it slide. I think you brought up a great point too, because I've seen legal language about self-dealing, and a lot of GPs will explain it to the investors. Oh, well, we have a in-house property management. So what it means is we're allowed to hire and no bid the property management because it's internal, but they do a great job. Everybody uses them, blah, blah, blah. And investors, a lot of times, they might just nod their head and say, okay, that makes sense. I will agree to it. And then the same GP will turn around and hire his affiliated concrete company for an inflated 2x bid, and he escapes through that same clause. You know, you kind of like created a path, a hole. It's a little mouse hole to get through. And the investor has agreed to it by thinking, oh, he means the property management cost fee. And then later it's, no, I actually did it for my law firm, my concrete, you know, whatever the self-dealing is, no bid requirement sneaks through. So again, I feel like the best investors are the people that read it. You got to be cynical, but at the end of the day, you still have to trust your GP because they're always going to find ways to cheat you out of money. But the legal document will give you hints, maybe, you know, to give you an idea of how egregious they're trying to be. What do you think, Matt? Is that your experience?
Oh no, yeah, absolutely. And it almost, you would wonder, like, why would that happen? Because it almost seems counterintuitive, because like you shouldn't expect an LP investor or a capital partner, as I put it, you know, to even invest the bulk of the money into a deal if the GP does not have a significant financial interest in it. I mean, Ron, you hit the nail on the head. I mean, we still see that. It seems like something like out of the last like century almost. But you know, like, yeah, with like self-dealing and you know, contracts and stuff like that, almost like you're dealing with the mob or something like that. But no, the fact of the matter is,
I hope I don't offend anyone. Like, union contracts.
Like, no, but yeah, like no bid contracts. But I mean, even if it hurts the GP or maybe like reduces his potential on the GP side economically, yeah, there are situations where they can make a lot more money on the management side that way. So that's why, yeah, you do have to be careful, and you need to be ready to negotiate for sure.
Yep, absolutely. And again, I think our audience is going to be a mix of investors who are capital partners, and then a mix of developers or GPs starting off as well. And they're figuring out, how do I draft my first set of partnership documents? So this is my advice is, you know, put something fair. It can still lean towards you. It can still favor you as a GP, but you're going to lose credibility with the sophisticated investors when they say, who are these guys? They're putting fees on top of fees on top of fees. I don't want to deal with them, and I don't trust them. If you want to be a trustworthy partner, you need to be in the market. You need to be in the range. Otherwise, it looks like you're just trying to make a quick buck and move on. Because I guarantee you, the investors won't be happy when they get their distribution checks at the end. If it's you know, costs are inflated from the budget. So good topic I want to talk about, you know, is how do you look at control within the group? Obviously, broad discretion is appropriated to the general partner, but what decisions can the limited partner actually influence?
The limited partner, again, because remember, I mean, most of the time in terms of the equity position, the limited partner can be putting in 90% or more of the money. So, you know, the deal doesn't happen without them. So, I mean, just the number one example is whether or not they have the power to determine when to sell the property.
Yeah.
Because especially if the GP, if everyone has done great on the deal a lot, and the GP tend to be the deal guys, always looking out for where the next great set of multi-year returns may come from. They may be setting their sights elsewhere, or if it's an asset, if it's a great piece of land, alternatively, that they want to keep their money in for decades, and all of a sudden you have an LP that says, well, no, we want to pull our money out. Well, if they want to pull their money out, they can have a clause in there to force a sale. And so this all needs to be unfortunately, even though no one has a crystal ball about the future, this all needs to be decided up front. And obviously it can be amended at any point, but it's usually decided up front, or the investment doesn't go forward.
Yeah. No, I think those are the two most critical decisions: is disposition and placing debt on the property, deciding to put additional debt or refinance debt on there. Those are the two most fundamental, powerful decision making. And there are some scenarios or partners that would have that right. And I guarantee you, a general partner doesn't want to give it to a limited partner, but if they can negotiate for it, they'll get it. Do we want to talk a little bit about the waterfall? We've got just a few more minutes here. Let's talk about like an actual distribution, such as Section 7, Article 7 of the template. Matt, do you want to walk us through just briefly? We've got 4 different hurdles here. Do you want to talk
Certainly.
through?
Yeah. So again, the number one thing to keep in mind when either constructing or modeling out and negotiating a waterfall is the alignment of interests here. And so, if the general partner thinks that this is a very, very high potential return deal, and they've worked really, really hard on it, obviously they want to get an outsized return and be compensated for all that they put in on an active basis as opposed to a passive one. Now, again, the LP, the passive investors, those are the ones that tend to be bigger, with more capital. They're looking to get more of an insured return. And so this is why in a waterfall structure, interests are aligned in the initial stages of it, just to make sure that the LP is getting their preferred return. So
initial stages, you're talking about like operations, distributions from cash flow. Okay. Because so if I'm looking at the limited partnership, Chapter 7, Section 7, A, 7.1.1A, to all partners, pro rata, each distribution reaches the IRR approved by the partner. That's what you're talking about in the initial period, is distributions from cash flow?
Yes. But basically, look, the LP is going to want something consistent in a lower return, but a more safe return every year. And so this is why in the initial stages of the project, this is kind of what I was getting at a minute ago. In the initial stages, that's not usually when you get right into your promote. It's usually toward the end of the project. If you're renovating units, if it's an office building, like if you're re-tenanting it, or retail, if you're bringing in new tenants and so on and so forth, and materially increasing the value. Well, only once you achieve that value are you really getting into the promote and getting the outsized return. Now, how do you get those outsized returns? This is the part that everyone loves to learn about. So if the returns are up to 7%, the general partner and an LP in this case will share them equally.
Yes.
And then once and so that 7%, that is the first quote unquote hurdle. And then in between 7 and I think 10%, then it will switch where anything, and now first of all, both parties are still splitting up to 7%. So this only kicks in when returns are in excess of 7%. So if returns are any returns between 7 and 10%, then 10% of that goes to the general partner, 90% of it goes to the limited partner. And then over 10%, you might go 85-15. And then finally, if it's a really a home run of a deal, you say, oh, anything beyond, 15 or 18%, let's say, it goes 50-50. And
so in this one, I think
extremely
it's
lucrative for the general partner if and only if they meet their financial projections, basically.
Right. So in this template document that we have, 3 hurdles, we get to the peak of a 60-40 split.
That is correct.
It's really useful to visualize this for me as a non-numbers person. I was a philosophy major in undergrad. The flow of profits, it gets progressively larger towards the general partner as you cross all these hurdles. The question is, how evenly do you start that split? Do you start it earlier and do you make it go very wide, or do you let it stay tighter, within the normal bounds for a longer period of time? And then you say returns above 30%, I get 99%, something like that. I haven't seen something that extreme, but there are different contours to how do you shape these returns where beyond just the normal pyramid, or, I don't know what shape it is, but it's kind of like mostly LP, and then it progressively percentage increases towards GP. Well, that's fine, but you can have a narrow slope or a decreasing rate of return based on how you predict the likely return range to be. We think it's going to be 15 to 19, or we think it could be 15 to 30. If that's the case, model it out. So if you get above 22%, you get a lot of the reward, because I think above that threshold, a lot of partners are willing to give it to you.
Correct. And my only caveat on that statement would be that, especially if you're starting out and you really want to make a name for yourself, obviously, you're gonna you won't be able to have those kinds of terms initially. But if you want to continue a relationship with a very, very good and reliable equity partner, and then this is just what I've heard within the industry. I think they say it always makes sense to cap it at some point, like, at 50-50 or 60-40 or something like that. So they're still, they feel like they're sharing in a lot of the gains. And that's especially true if you think you have a very, very good business model that you want to replicate on other deals with that same equity partner.
And so 60-40 still in favor of the LP.
Absolutely. Yeah.
See, so I think that's really great insight in terms of what the market bounds are. And again, the reason why we do this thing is because it's a partnership. It's not here, let me borrow money from you and then I'm going to make a bunch of money. It's let's have a partnership. We're risking capital together. Let's share the rewards together, versus I would say maybe the mentality of, hey, I'm putting 10% of the equity into this deal, but after we close, I get 8% of my equity back via fees. So I've got really in reality 2% equity in the deal. That does not create the same incentives. Again, coming full circle, if you get all of your equity back off the table through fees, it's not an alignment of incentives. You have de-leveraged yourself tremendously. And again, it doesn't have to be the same, but you're not aligned. If I'm only 2% into a deal, I'm going to do some pretty risky things because it's rolling the dice. So,
yeah, absolutely.
All right. Well, again, I want to thank Matt. It's really been insightful. I learned a lot. I love talking to my counterparts in the industry. Again, what I work on is taking the client's interests and the client's goals and then transforming those into the legal documents and making sure that it reflects what they intend, because a lot of legal documents do not match what you think it means. But hopefully this was helpful. Check out the template, subscribe, and we will have more content for you. Coming up next is actually a really exciting anchor tenant leasing. So you'll wanna tune in for that one. All right. Thanks, Matt.
Thank you very much for having me, Ron.